Welcome, everybody, to this week's podcast. My name's Andrew Wilkinson. I have an incredible team around the table here. Welcome, Kevin Davitt, Head of Index Options Content from the NASDAQ, Steve Sears, Options Columnist at the Barron's, and Steve Sosnick, who is Interactive Brokers Chief Strategist. Welcome, gentlemen. I hope everybody's doing well.
Great to be with you.
Great to be here, Andrew. Great to be with this group.
I feel the same way.
Very good. Let's get underway. I wanted to start with Steve Sears. Now, it's the week before Easter. It is Wednesday. We're recording middle of the week. Last week, stocks looked like they'd broken down, and a lot of that obviously is due to the Iran war. Has President Donald Trump figured out how to soothe the market with words? If that's the case, just how dangerous is that tactic? What do you think?
I think he most certainly understands exactly what investors want to hear and need to hear, and I think he's expert at delivering those messages on social media. I can't recall a time, quite frankly, when X, Twitter, figured so prominently into the investing playbook. Is it dangerous? 100%. Because I've been on a number of briefings with, very senior intelligence and military officials, retired, and they speak about Trump's style of communicating and negotiating as being unpredictable. And there's one thing that we know, it's one of the oldest saws on the street. Market can handle good news, the market can handle bad news, it can't handle uncertainty. Well, Trump seems to have flipped that on its side. And so the uncertainty is at the highest that I can recall it being since the global financial crisis. However, you can see what happened with stocks yesterday. We had an enormously bullish move across all markets.
Steve, imagine if the Iranians had Twitter or something too.
They do, and the Speaker of Iran's parliament has been tweeting out pretty decent investment advice. Believe it or not, he started yesterday, and earlier before the open, he encouraged people to not give in to the fear of missing out, which is a topic that we've discussed many times over the years here in this forum. So it's a complete battle of words. All of you know, just before, I believe it was the declaration of World War I, I believe it was the U.S. Senate, one of our elected officials said, "Truth is the first casualty in war." And it gets trotted out from time to time, almost whenever we have conflict. This conflict is no different. And I think about that as I watch the stock surge amidst this battle of the words. Last week I called it the battle of tweets.
Steve Sosnick, what are your thoughts here? The CBO's VIX hasn't gone up through the roof. What's happening with volatility in broad terms?
In general, volatility is higher. I mean, as you'd expect, we are more volatile. So, it would be crazy if we didn't see measures of volatility rise. So that in and of itself, that's reflecting the reality, right? I mean, remember what VIX is and is not. You guys have all, if you've read my stuff before, and I assume if you're watching this podcast, you've seen the phrase, VIX is not a fear gauge, but it plays one on TV.
Hey.
But so with that in mind, VIX there is no explicit sentiment measure as VIX. It is derived from S&P 500 futures, or in the case of VXN, derived from NASDAQ 100 options, I should say. And this is the market's best estimate of volatility over the coming 30 days. The standard best predictor of volatility over the coming 30 days is what have you done for me lately? And what we've had is big intraday moves, right? I mean, we had a giant move yesterday. We had a giant move on Friday. We had a big move on Thursday. Why shouldn't volatility measures be elevated?
Well, I want to take the opposite side here, if I can. VIX is elevated. The long-term average is 19. It's now about 25 to 30. It's the best fear gauge that we probably have out there that people can understand. And I'm very curious to get Kevin's views on this. VIX, I think, would be materially higher were it not for the fact there's an enormous amount of index options being sold on a daily basis to generate yield.
that point is one that I think has been brought front and center over the shift in duration and interest toward the front end of the curve over the past couple of years. I'm a little bit reluctant to take the other side of both of you on this point, or actually, I'll just point out that from a realized volatility standpoint, this year thus far has not been unusual. So I would point out that the NASDAQ 100 has realized volatility around 18 and a half calendar year to date, and the S&Ps are realizing like 14 and a half. And those are not unusual numbers from a realized volatility standpoint. The market has priced in greater volatility. And when we talk about the moves yesterday, I believe the close over close move yesterday was the biggest we've seen since like fall last year.
Yes.
We've seen 1% moves here and there, but a dearth of 2% moves. And for VIX to continue to realize something in the neighborhood, to express, the market needs to realize higher volatility. And this is one of the points we were batting around before we kicked off, but the impact of skew, or what index skew has been telling us. And there have been some shifts when you look at downside volatility relative to upside in recent weeks. And I'd love to get your guys' take on what that might be telling investors.
That actually was where I was leading to, and I'm glad we took this detour, but that actually really was an important point that I wanted to get to. Was part of the thing about VIX and the VIX measurement is it's not strictly, it will always trade above historical or realized. And the reason for that is because it includes wings, and it includes extreme wings. And I know NASDAQ, tried to use vol Q, which I think was actually in many ways a more sensible measure, limiting the number of strikes up and down. But regardless, if there's a bid in an option that's 20% out of the money, it gets, as long as there's a non-zero bid, it gets included in the VIX calculation. And so what happens here is we've had a big shift. And yes, you'd expect the curve to have a parallel shift upward when volatility increases. You'd expect to see a steeper skew to the downside when you've had a series of downside hiccups. We've gotten that to some extent, although actually it didn't really steepen all that much to the downside. The more interesting part to me is that the curve, which is always described as the Elvis smile, sort of like that sideways, that sort of, Elvis asymmetric smile, it's actually gotten quite a bit more symmetric. Not 100%, but what we've seen is as we've gone lower, implied volatilities and upside calls in major indices have increased. And there's two reasons in my mind for this. And I'd love to bat this around and get your ideas and see if I'm off base, on base, or semi. One theory of mine is it's FOMO insurance. And that is people remember what happened out in last April, which is almost exactly a year ago now, when, we went down after Liberation Day. And I'll argue the bigger reason we went down then was because the president and Besant and Lutnick were seemingly tone deaf about markets. And that was the last thing the market wanted or expected from the administration. Then when they took a more market friendly tone, off we went to the upside. We had a 9% rally, and people, it was a face ripping rally, to use the parlance. And so people are either speculating on that, or they are doing the sensible thing that we have when you have a downtrend, which is sell rallies predominantly rather than buy dips predominantly. But most people are not comfortable trading from the short side, and particularly in an environment like this. So that was their insurance, was no longer the downside insurance so much, but the upside insurance. And, I'm trying to reconcile those two theories. I think the answer is probably somewhere in between, and I want you guys to weigh in.
In my view, I think the answer, the explanation for this is less financial and more societal. I saw news this morning that most Americans can't gather together $500 to pay for an emergency. They have less than $500 in their bank account. So what's happened over the past, 5, 10, 15 years, we've seen investing and trading become more like a speculative gambling market. And the fear of missing out, perhaps, is not so much a FOMO virus, but you have to be in the market. And if you came of age post GFC, which is, was 20 years ago, what do? You buy stocks, and stocks are great, but you look at the volumes, which we can remember when it was a big day when we did 1 million contracts in options. I think now it's like 44 million. So people
About
come in here
60 now. We're almost up to 60 million. I think it went from 15 to 60 in the last 5 or 6 years.
So it's been corrected. So what are you going to do to play? You're gonna buy calls. You're gonna sell. You're gonna sell puts, and I think that this distorts volatility within the indexes. And plus, the one thing that we have that we've never had before in this market are gigantic options funds run by very sophisticated, smart guys who can come in on the wings and look at various, skews or burps and vol, and then take advantage of it and sell it and knock it down or push it up.
But does that fully explain the sort of rare thing where we did see this upside skew in NASDAQ as the Mag 7 was going crazy to some extent. QQQs, because, at least particularly individual
going
stocks. And I think that's Kevin's bailiwick, so I don't want to step on it. But I think your answer is part of it. And I think that's why there's this desire for the FOMO insurance. And just because you can't miss out. And we could do 2 hours of the blurring of the line between gambling and investing at this point. But so I'm not going to dismiss that point at all.
Kevin, skew. I'm all shook up. What do you think?
This happens to be a point that has captured my attention in recent weeks. I think about relative auctions exposure. And generally speaking, the moves we see in index options market in the NASDAQ 100 typically are very similar to what you see in the S&Ps. But to the point that we have been slicing and dicing here, the cost of a 1 month, 10% out of the money call option in the NASDAQ and NDX relative to SPX got as cheap as it's been in roughly 5 years earlier this month. It coincided with standard March expiration. Now, just to put a couple numbers around that, not get too convoluted, typically that option trades at roughly a 4 volatility premium to the S&Ps. It got down to about 1.5. And now in the past week and a half, that vol sort of premium moved back up to 5, like a much more normal level. Does speak to some sort of behavior where people are concerned about that rebound. But the backdrop to this market is very different than the one we saw coming out of like the ChatGPT launch end of 2022, where the backdrop here is the NASDAQ 100 fell nearly 12% off the late October highs, is down roughly 9% in the quarter. And so to see markets right size, as I think risk reprices faster than it ever has in this environment. The one last point I would make is that the sophistication in the marketplace these days is beyond what I could have ever expected even just a decade ago. And there has been a proliferation of these funds that gather significant assets and attention that generally speaking sell volatility. Now, for the most part, they do that systematically, as opposed to the type of players that can look at skew and say, I think there's opportunity at this point in the distribution, right? These funds do things mechanically, and that can open up opportunity to people that understand the sort of language that we're using and the dynamics in the market that can shift very quickly.
I want to come back to Steve Sosnick. Something we were talking about before we started recording. Does this look like 2008 all over again to you?
This part, no. The 2008 stuff, that private credit sort of has fallen to the wayside because that was the sexy story, but it's not nearly as immediately important as a closure of the Strait of Hormuz. But, I did have a very prominent New York-based restructuring attorney, co-head of restructuring at a fairly large New York law firm, say to me over lunch one day, just, socially, that this reminded him of 2008 all over again. Or actually, his words were, "You do realize this is 2008 all over again." That's a pretty extreme statement, but I have to take that with some grain of, with some respect, because the restructuring people are the first line in all this, right? If you're gonna have big markdowns, you're gonna want your debt restructured. They used to all be bankruptcy attorneys. They don't like the word, bankruptcy. They've upgraded their terminology to some extent, but and which is good, because you do want to see them restructured rather than just go right into chapter 11 or worse, chapter 7. But they're seeing this, and the issue that I have is, I don't think that private credit is as pervasive as subprime mortgages were, because the subprime mortgages at the root of it affected ordinary people. Private credit, unless the government really has its way and allows us to put them in 401ks, which actually was literally proposed this week, until or not, you really don't have exposure to this asset class. And it's, I think, $2 trillion out of a much larger financial system. Problem being, trouble occurs at the margins. And what we've seen is stuff marked to market, just marked at par, because the rules in an opaque, non-tradable market are much looser in terms of marking things than they would be if there was a public source of trading. And one of the examples that I've given is, I looked at a lot of this private credit was issued in sort of in the post-COVID period where rates were really low. And that was this attorney's comment was, we got into this mess because everybody overlooked due diligence and covenants because they just wanted to lend money at higher rates. And there was such a demand that the issuers would go to the lenders and say, we want to put this piece together. And they would say, good, we need 2 weeks to do due diligence. And they would say, well, we can get this done tomorrow if you don't do due diligence without you. Okay, we're in. And now this is what happens. This is what keeps attorneys busy. But, what's going on here is, if you look at one of these loans that was issued, then I did some work a few weeks ago. The numbers are a little out of date because rates have moved. But I looked at just IBM bonds and notes that were issued in 2021 and 2022 when prevailing rates were very low. Well, these were issued at par with sometimes coupons starting with a 0 handle, sometimes coupons starting with a 1 handle. And those loans, depending on time to maturity now, are marked between, call it 98.5 and 95 or something like that. Now, there was nothing changed in the credit quality of these notes, right? There was just prevailing interest rates went from 1-ish to 4-ish, and that reflected the change in interest rates. So to me, it's kind of fictional to say that all these loans that were issued then are still at par, when it's obvious that unless there was a marked improvement in their credit quality, which they can't all have improved their credit quality over that period of time, the stuff that didn't have changes in marks, to me, is a bit sketchy, a bit, and then when you have things like someone like BlackRock saying, oh yeah, we had this, this was in our portfolio at par, and now we're going to mark it down almost to 0. That's telling you that there's stuff out there. Is it truly as systemic as the global financial crisis? I'm going to say probably not, but we could get really ugly without things being that bad in the meantime. And I'm going to throw it open to the other guys because I've been monopolizing the time here.
This is.
Well, I remember a very suave strategist at a very suave, large investment bank asking the potential investors, can you afford to be illiquid? And of course, the answer is, well, yeah, I'm rich enough to be illiquid. Like, what do you have? I'm going to pay you X 100 bips above whatever it is. And oftentimes the banks were moving debt off their balance sheets and packaging it. And the debt that was on the balance sheets was from commercial bank clients not big enough to access capital markets. So there's a whole massive ecosystem that exists. In addition, we've also seen the rise of private equity in the past decade when rates were as low as they were. So I imagine that this is simply a growing pain for that industry, which if you went to any financial conference over the past decade in particular, there's always a hall packed with the private equity guys doing their spiel. So Does it become a big issue? I well remember during the financial crisis when the muni market froze. I mean, there was no liquidity in it. And what happened? ETFs for munis, because who's the buyer of last resort when the institutions or the ultra high net worth, want to sell, but no one's there? It's John and Jane investor. So I think that there's an issue, but I don't know how to size the magnitude of it. In short, and it's just one of these things we have to that will be worked through. What concerns me, to Steve's point about the due diligence, it's like, due diligence, what's that? You mean I have to research things don't quite go up? You just don't know how much garbage is there, because as Steve said, we have these problems on the periphery, but all kinds of horrible stuff happens on the periphery, and it tends to multiply like a bad infection. And I just don't know how it's going to be taken down.
I'm still having a hard time with the FOMO argument that this market goes higher. I feel like investors have become so entrenched in this buy the dip psychology that with what is essentially a new world order because of thanks to Donald Trump, I can't help but think that it's just been treated as another crisis and it'll be gone soon. Kevin Davitt, where would you put your money? On a new high for the year or a new low for the year?
I think
you can say both.
Yeah, that is my inclination. I am slow, and maybe I've just had enough coffee this morning to be somewhat glasses half full to bring in a 2008 analogy. I do think, incentives, and I think about psychology, and sentiment has gotten about as low as it has in many years lately. And there's always going to be someone making the comparison to that awful thing that people our age remember. In reality, markets are, like the weighing mechanism versus voting long-term, right? I wouldn't be surprised to see both new lows and potentially new highs this year. If there's something this year reminds me of, it's a very similar period from last year where markets fell kind of into end of quarter. There are some unique corollaries to big option positioning that the market moved through last week and back above yesterday into end of quarter positioning. And then last year we had this overhang with liberation tariffs. Now, things are probably not likely to resolve as quickly, and the heads up on Twitter or Truth might be coming from Iran this time. But what is certainly different from our reference to World War I and Truth is that options are available and broadly being taken up by the investing public, and we are able to express views about sort of specific areas of the distribution. And I think a lot of people are looking to do. There has been less attention further out in time. And when I look at something like a VIX 1-year measure that keeps kind of grinding higher, that gives me a little bit of pause. But if I had to be put on the spot, I would say that realized volatility probably continues to move up closer to what the VIX or VXN index have been implying. And we get wider ranges in the coming weeks, and ideally some clarity around the Middle East situation. Hopefully this doesn't drag out for months and months.
I'll tell you, if I can add one thing here about the upside. Before all this stuff began, within 6 to 8 weeks ago, there was huge OTC trading in SPX 8,000. And you had institutions were coming in and they're doing these very narrow spreads, like 2-3 point spreads, OTC. And then the desks were laying off the risk with wider spreads enlisted. So, to Kevin's point, I suspect, if we can make a move like we did yesterday on a tweet that the war is over, then really anything is possible.
Steve Sudnick, final thoughts.
We're taping this Wednesday morning. Markets are a bit higher because there's sort of more back and forth with a positive spin about, potential for peace in the region. The president is going to be speaking tonight, so we'll learn a bit more. Although, to me, two pieces, I think that we were off to a more enthusiastic start before two things happened. Number one, a very sensible piece of news saying that, okay, from the president saying, oh, by the way, we're not going to call this over until the Strait is reopened. That's a good, basically, to me, I was like a little stunned yesterday because the initial reaction was, wait a minute, we're just going to walk away and leave this a problem that doesn't solve anything. But now, Iran basically saying, once again, no. So again, what I would say here is follow the oil markets. Yesterday, we didn't really get a big move down in oil, which is telling me that the oil traders were relatively skeptical. And also watch the shape, if you can, watch the shape of the Brent crude futures, the steepness of the backwardation. And it's important to realize that, looking out a year in the futures markets, so let's get rid of the initial noise. They're in steep backwardation, but they're still pricing in about $15 to $20 higher oil than they were pre-crisis.
Because it's
telling you that
months to clean this up in the shipping industry.
Yeah, exactly. It's a pig in a python problem. And so we're not going back to where we were. I do think also yesterday, if we are going back to where we were, it's not going to be immediate. And the other interesting thing is, remember, Kevin, you alluded to this. Yesterday was end of the quarter. And I think you had markets, people do not like trading from the short side. I alluded to that earlier, which is part of my theory about upside skew. People are not comfortable. It's unnatural to a lot of people.
Does that include selling puts and calls?
Well, I just mean selling. I just mean trading delta from the short side, whether you're short, selling rallies as opposed to buying dips. Buying is natural to people. Markets are supposed to go up.
Yeah.
You've coined the term, which I've done my best to popularize. Yesterday was the perfect example of socially acceptable volatility. Okay. And right. I mean, Thursday, Friday, those were plain old volatility. They were scary. Yesterday, we had a bigger move and everybody was happy because it was socially acceptable volatility.
If we could just create a socially acceptable volatility index to complement the fear gauge.
I think so. I think maybe that's our next project.
My argument there would be that the NASDAQ 100 with kind of a 1.2 beta relative to the SPX, what we see when markets are moving higher is that expressed typically without performance. That volatility spread has narrowed as typically happens during some sort of crises. But I love that thinking because it so clearly reflects sort of long-term behavior. And I think we could see it on full display both ways in the coming weeks. Socially acceptable volatility. I love it.
Brilliant. That's an expression I have to add to the Interactive Brokers Campus glossary, where you'll find fantastic terms like backwardation that Steve Sosnick was just talking about. So I'd love to thank my guest, Steve Sears, the striking price columnist from Barron's. Thank you, Steve.
Thank you, sir.
And Kevin Devitt, head of index options content at the NASDAQ. Thank you very much, Kevin, for joining us today.
Thank you, Andrew.
And Steve Sosnick, who's heading out of here, hightailing it to Long Island as soon as he can. Steve, thank you very much for taking the time this morning.
Thank you. And this was a real treat. I really enjoyed this discussion. Thank you. Thank you for arranging it, Andrew.
All right. And I hope, Steve, you don't come across any pigs and pythons on the way.
I certainly hope not.
All right. Thanks to everybody for taking the time to listen. If you've enjoyed today's podcast, remember you can subscribe wherever you download your podcast from. Bye for now.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice. Options involve risk and are not suitable for all investors. For information on the uses and risks of options, You can obtain a copy of the Options Clearing Corporation Risk disclosure document titled Characteristics and Risks of Standardized Options by going to the following link ibkr.com/OCC. Multiple leg strategies, including spreads, will incur multiple transaction costs. Any discussion or mention of an ETF is not to be construed as recommendation, promotion, or solicitation. All investors should review and consider associated investment risks, charges, and expenses of the investment company or fund prior to investing. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice. Alternative investments can be highly illiquid, are speculative, and may not be suitable for all investors. Investing in alternative investments is only intended for experienced and sophisticated investors who have a high risk tolerance. Investors should carefully review and consider potential risks before investing. Significant risks may include, but are not limited to, the loss of all or a portion of an investment due to leverage, lack of liquidity, volatility of returns, restrictions on transferring of interests in a fund, lower diversification, complex tax structures, reduced regulation and higher fees. Futures are not suitable for all investors. The amount you may lose may be greater than your initial investment. Before trading futures, please read the CFTC risk disclosure. A copy and additional information are available at IBKR.com. Short selling is an advanced trading strategy involving potentially unlimited risks and must be done in a margin account. Trading on margin is only for sophisticated investors with high risk tolerance. You may lose more than your initial investment. For additional information regarding margin loan rates, see ibkr.com/interest.